Good afternoon and welcome to our webinar series, Tedstrom Talks. This is the 16th in a series of webinars that we are producing to give our clients, business associates, friends, and family pertinent and important information on COVID-19 and other interesting and timely topics. Your video and microphones have been muted. However, please feel free to use the Q&A and chat icons located at the bottom of your screen to ask questions throughout the presentation. I would like to introduce you to Peter Tedstrom, founder and chief advisor of Tedstrom Wealth Advisors. Peter has 36 plus years of experience as a certified financial planner. He has been consistently recognized through awards and recognition as one of the country's top financial advisors. Peter, take it away.
I have a distinct pleasure today to introduce our newest team member, Ben Michalski. Ben joined us in June of 2020, one of our crazier years, as we all know. He got started in the investment management industry in January of 2012 after receiving his BS in finance from the University of Wisconsin-Milwaukee. Makes you a Badger, doesn't it?
Badger fan, but we are actually the Panthers.
Oh, Panthers, okay. After 2.5 years with Edward Jones, he felt the mountains calling and decided to relocate to Denver in September 2014. That happened to a lot of us, I know. And while in Colorado, he's built his foundation working as a mutual fund analyst and wholesaler with Transamerica for 5 years. And when not at work, Ben enjoys snowboarding, camping, playing guitar, and cooking. I know he's become a real Coloradan in a short period of time. And I haven't tasted any of his food yet, but since he likes to cook, I wouldn't mind trying it sometime, Ben.
Absolutely.
Anyway, welcome, Ben, and let's get things started.
Excellent. Well, thank you, Peter, for the kind words. Very excited today for multiple reasons. The first is that, as Peter alluded to, the newest member of the Tedstrom team, and though I've been able to sit in on all of the webinars that have taken place since I joined the team, this is actually the first one that I'm able to contribute to and be a part of. So that's really exciting for me. The other reason I'm really excited about this specific Tedstrom talk is that it's about the election, which, as we all know, if we've turned on the television anytime recently, there's a lot going on and a lot of issues at play. And so we want to be a resource to y'all and give you some information and really cover some of the important issues that we are going to see here becoming prominent in this upcoming election. Things like the coronavirus, pandemic, race relations, healthcare, interest rates, unemployment. These are all top of mind for really the entire country and the world. And so we feel as though this is a really important election, and we want to make sure we're giving y'all some information to help you make the right decision and a decision you're comfortable with. So
and what a year it's been, Ben. Oh my goodness. We've all been waiting for the election, or maybe hoping that it was over sooner, because we've certainly heard plenty about it with the debates and advertisements, and certainly the media has gobbled up a lot of stuff or spit out a lot of stuff to us around the election. We're going to try to make sense of the election from an investment standpoint and a market and economy standpoint today.
So Peter, if you want to start off with this first slide.
This is an interesting slide, guys, in that it shows the stock market over long periods of time rises, and anybody who's spoken to me over the last 36 years I've been in business, that's pretty much been my mantra, is stocks rise more often than they decline. And even in recessionary periods, which you can see those orange bars, and you can see in recession, stocks generally will fall in recessionary periods, yet it doesn't stop the market from going up long term. And so I always feel it's a bad bet to bet that we shouldn't be in stocks. Stocks will surprise us regularly for any number of reasons.
That's right. And this slide really leads into our next slide perfectly. And what it's showing here is that actually since 1932, incumbent presidents that have experienced an economic recession in the last 2 years of their terms have not been reelected. And you can see here, it's very cut and dry. There's no gray here. So since all the way back to President Hoover, if you experience a recession in the last 2 years, the incumbent president is typically not elected. So this year was rather interesting. We counted the recession that took place from end of February through the beginning of April to only be about 33 market days. So we're curious if this year, since the recession was such a quick blip, if you will, if that will still be impacting the votes of constituents.
Yeah, I think it's fascinating that the historical perspective is longer recessions. The shortest recession we've ever experienced, I think, in the history of our country, we just experienced, and we experienced it for very different reasons than we've experienced recessions in the past. And really, what we're identifying or noticing, folks, is that we have a bifurcated recovery that's occurring. We're seeing the stock market recover, and we're seeing various segments of the economy recover very, very nicely, and some that are in dismal shape and not likely to get any better for quite a while.
That's right, and so many of us have discussed this idea of a V-shaped recovery, or most recently a K-shaped recovery. And so Peter and I have discussed this at length, and what we're seeing, if you think about the letter K, is there's some very clear winners. It's a lot of the tech names and a lot of innovative companies that have been forced to innovate, but they've been successful and they've been able to remain profitable. Then there's other sectors and industries. If you think about restaurants, these folks might have been laid off indefinitely. You're not able to dine in all locations. You might need to be outside, and so really, a lot of businesses like that are on this downward trajectory of the K-shaped recovery. And obviously, there's voters who have benefited, and there's voters who have really felt the impact of this coronavirus pandemic. So it'll be very interesting to see if that impacts their vote, and if this holds true of what we've seen here since 1932.
Yeah, I think investors are confounded by the market recovering as quickly and as aggressively as it has. And I think it's because some of the industries that we're most often involved with, restaurants, theaters, movie theaters, concerts, activities where people gather, are truly in a lot of trouble. And we all know that. And then there's other segments that have actually benefited from it. I have a close friend who owns pizza stores, and he's up 50% this year.
Wow.
On pizza. And then Zoom. We use Zoom every day, almost the entire day. And our phones, so Apple and Google and the things that we're using more and more because we're at home and we're isolated, have obviously benefited from this challenging environment.
Absolutely. And just to put it into context a little bit, if we look back to 07 through 09, that was actually the longest recession we've experienced. And again, for different reasons, but I think it's playing with investors' minds a little bit, because that was a very long amount of time where we were feeling this recessionary pressure. And this time we were able to, like we said, in about 33 trading days, turn it all around. So it really is an interesting time to experience this.
Well, let's look at what people, I think, what's on people's minds these days, and that is what happens with this election. We're not going to predict who wins. That's a foolhardy process. You guys have read the polls or have heard, and we even know that polls are often not great predictors of winners of elections. But what we do know from what you all see on this particular page is that regardless of the makeup of our government, divided 20 times in the last, I don't know, what time frame are we looking at here, Ben?
So this is since 1948.
Since 1948, we've had 20 periods with a divided government. We've had 11 periods with an undivided Democrat government, meaning all three branches are Democrat. We've had 5 where it's undivided Republican, and 14 periods where there's a change in composition by party. And what we see here is, on average, not every time, but on average, just before the election and following the election through 12 months, and we don't have the statistics beyond that, but following the election up to 12 months, the markets are higher, and they're higher reasonably nicely, 7% to almost 10% of annual returns following elections.
That's right. And so one of the conclusions that we can potentially draw from this is just really that there's a lot more to capital market returns than just the political parties. Uncertainty is often the biggest challenge to profit maximizing strategies. So companies trying to figure out the best move going forward. But once participants know, or these companies know the rules and who's going to be implementing them, that they'll look to maximize those profits with the government that they have and not the government that they want.
Yeah, what we've found, Ben, I know you agree with this because we've talked about it, is it's so much less about the politicians or the individuals who are voted in or voted out, and it's much more about the economic backdrop that the market's relating to. And markets hate uncertainty. It hates surprises. So when certainty becomes actualized or realized, like we find out who our next president is going to be, markets are likely at some level to settle down. Now, we know that we've got an issue here with regards to being a potentially contested election. And a contested election breeds more uncertainty, which could mean that we have a couple of months following the election of market volatility and downward movement as a result. Again, not a prediction, but it's certainly a possibility.
That's right. And with the increase in the mail-in ballots and such, there's talks that there could potentially be some delayed results. And like we say, typically the market doesn't like that level of uncertainty. So it'll be interesting to see how that all shakes out here. And I guess just next week. So
just next week. Yeah. Less than a week away. Yippee. No more ads in a week. All right, Ben, you want to talk about the Senate and the House?
Yeah, a little bit here. So there has been some rhetoric around this idea of a blue wave, if you will. And so what we're seeing here is that the House of Representatives, as you can see, is Democratic at this point in time. And the number of toss-up seats at this point in time is 28. And so even if you were to add that figure, okay. So what we expect here is that quite a few of those could potentially go Democrat. Because what we're trying to say is we don't expect them all to go Republican, which would in essence be necessary for the House to shift over to a Republican control.
Well, it's almost impossible, right? If we take the 28 and add it to the 186, we're at 214, which says that it remains Democrat.
That's right. And that is what I was trying to say, but I second guessed my math calculation.
No, you're good.
Yes, exactly. Even if they all went Republican, we would still not see the House flip. So in that way, we do anticipate that to stay Democratic. However, the Senate, on the other hand, is a much closer race. We're showing that 48 are likely going to be Democratic, 47 likely Republican, with 5 toss-ups. So there is a lot more up in the air as far as which direction the Senate may go.
And then what happens with stocks during those different periods where we've got split Congress, Republican, Democrat, is on our next slide. And what we see here, it's obviously more advantageous to be invested when we have a split Congress. And I think we all understand to some degree what that means. It means that there's checks and balances. When the House is one party and the Senate is another party, there is a sense of inertia that they can't get anything done, and there's some frustration around that. On the other hand, it means that these parties can't run hog wild with their policies. There's that check and balance. And even if it's all Democrat or all Republican, there's still a very reasonable return anticipated or experienced in either of those scenarios.
That's right. And I think that that's a really interesting finding, and one that could potentially surprise some of our viewers today.
Absolutely. The next page really is all about what really has happened with the last 4 presidents relative to the stock market. And the outlier there of the 4 is Bush, who inherited the Great Recession, 08, 09, or it started in at the end of his term, and you can see that during his term is a minus 2.9% annualized return. But the other administrations have all had double-digit returns on an annual basis.
That's right. So right off the bat, if you look at Clinton, the opponents were saying that increasing taxes would have a really negative impact on the economy. Obviously, taxes are, again, a big issue in the 2020 election. And so if you look at it from the perspective that taxes are always bad for the markets, you're going to be looking at it in a way that history hasn't shown us, right? And so we're saying, yeah, there were tax increases, but we were able to annualize 17.2% on the S&P 500. I don't know too many folks who wouldn't be happy with a 17.2% return on the S&P 500. So other things such as tax cuts. Seems like it makes sense, right? However, with George Bush, we saw that there were some tax cuts, and yet we saw a negative return. So what we want to make sure people understand is that there's a lot more to these capital market returns than simply one policy, and especially one policy that these folks are campaigning on. So we need to remember that there is a huge difference between campaign rhetoric and political reality. As these folks actually try to move these issues through the legislative process, a lot changes because, again, we have that system of checks and balances.
And to bring us to present day, which is fascinating because we've heard President Trump speak about Biden's desire or campaign statement that he's going to raise taxes, and Trump says that's going to destroy the economy. Well, to the contrary, that has not been the case. And on the next slide even shows that since 1926 through 2018, what you see there, guys, is that, is that a gray? I'm colorblind, Ben. What is that, a gray stripe?
That's right. These are gray bars. Yep.
Okay, so those gray stripes, everyone, represent when taxes were increased, either corporate, individual, or capital gain, or any combination of those. And there was only one period in the periods you see here where stocks declined, and that was during the Great Depression back in 31 and 32. Otherwise, tax increases don't appear to have a significant impact in the performance of the stock market.
Right. And some folks may say, well, what about corporate versus capital gains? There's been multiple periods in time when corporate individual rates and capital gains rates have all been raised, and yet we still managed to see a positive annualized return in the S&P 500. So pretty fascinating stuff right there.
Yep, you bet. When we think about the odds of a Trump re-election, we all know, I think we all know, most of us know that his approval rating is below 50%. We looked it up today, and a couple of days ago it was at 43.3% approval rating. Now, polls have come under question over the last 4 years for obvious reasons. What's really interesting here is that of those presidents we see here, Ben, only one has won re-election with a 40 to 45% approval rating.
That's right. And so that was actually Harry Truman. So according to the polls, really didn't have much of a chance, yet managed to become reelected anyways. And so one thing that we have found is that incumbents historically are reelected 70% of the time. So there is some advantage there. There's, again, less uncertainty as far as what direction they may go. And especially after the last election, polls have, as you said, come under increasing scrutiny. So this is a really interesting slide for that reason.
You bet. Now, do we need, does the president need the popular vote to win the election?
Right. So this is a really interesting topic today, and actually there's some ballot initiatives locally here in Colorado that pertain to this. But so the short answer, Peter, is no. They don't need to win the popular vote to become the president. In fact, over the last 72 years, 6 presidents have become have won without winning the popular vote. Yep. So we'll notice Truman, Nixon's first term, Clinton on both terms.
Sorry, I'm interrupting.
Well, actually, President Clinton lost the popular vote both times. So that's interesting. George W. Bush, as well as Trump, all of these folks lost the popular vote, and were still became president.
Yeah, it's not that uncommon. I think we forget that there have been several other presidents elected without winning the popular vote.
Right. And so for local folks here in Colorado, on our long list of initiatives to vote on, one is Proposition 113. And that has to do with Colorado joining the National Popular Vote Interstate Compact, which is a lot of words, but it's a pretty simple idea. So Colorado currently has 9 electoral votes. And so if you were to vote yes on this initiative, you would be saying that the electoral college votes, those 9 votes that Colorado has, would follow the Colorado popular vote. So if Colorado goes Republican as their majority, then all 9 of those electoral college votes would be for the Republican president. If we were to vote no, and actually I think I just got that flip-flopped. My apologies on that. But the other implication, so really what's at stake is either we go by the popular vote of Colorado or we go by the national popular vote. So what Colorado would be subject to is we could even have a majority of Republicans vote in our popular vote in Colorado, but still actually have our electoral votes go the other way if the nation voted Democratic. So it's a really interesting ballot issue.
It really is. And today, though, we're relying on the Electoral College to determine our next president. And that slide on the next page kind of gives us perspective of which states typically go Democrat, which ones typically go Republican, and then which ones are more swing states, or what the term we're hearing quite frequently these days are battleground states.
That's right. And so this is an interesting slide as well. So first off, I just want to start, there's a lot to digest. So I want to just go through exactly what we're looking at here. So the dark, actually, let's start with the numbers. So the left side number, so let's use Alaska for an example. The left side is the amount of times that the Democrats have won. The right side is the amount of times that the Republicans have won. So as you can see with Alaska, they've gone Republican all 10 of the last presidential elections. And so if that's the case, either 9 or 10, so 90% of the time, if you went with one party or the other, you're going to be in these more bold colors. So this dark red has gone Republican 90% of the time or greater. The dark blue has gone Democratic 90% of the time or greater. Then we come into these slightly lighter shaded ones, so these lighter blues. So for instance, Washington, Oregon, California, those have been majority Democratic, right? So 80% of the time for Washington and Oregon, 70% for California. On the flip side, these pink colors, Missouri, Arkansas, Kentucky, they've had 70 to 80% of the time gone Republican. So they do show some political allegiance, but then where it gets interesting is all of these gray states are what we call our swing states, which are in essence a 50-50 flop. They've gone to one party or the other 4, 5, or 6 of the last elections.
And we have a couple new swing states, don't we? Or a couple new battleground states, don't we?
We do, yeah. So this state. This page here shows traditionally where we see a lot of our battleground states. But this year, actually, North Carolina and Georgia are considered battleground states as well. One thing that I find really fascinating about this slide is that they're considered battleground states, but many of them have gone in one direction very consistently. So it just appears as though the margin in which that party has become victors has been getting smaller. So if you remember, Minnesota actually has been Democratic 10 out of the last 10 elections. But if you see here, maybe by a 2% margin, give or take, a very small margin in the last election. So it appears as though the I guess the level of or the magnitude of their not quite sure how to the margin is getting much smaller and the races are becoming a lot tighter is a good way to put it.
Yeah, I think when I'm trying to remember back when we had the hanging Chad issue with Bush and Gore, I think there were a few thousand votes that separated the two. And I think that's the point you're making, is that the separation per state, particularly in those last 6 or 8 states you guys see on the far right, had very, very small margins of victory.
And what would be the implication of, for instance, Minnesota going Republican for the first time out of the last 10 elections? That might not you really even be on the radar of political pundits, yet it like you say, might only take a couple thousand votes. So it's an interesting time.
Yep, sure is. Now, many of you out there today listening might wonder, well, where can we make some money? Because you guys are our money makers. And yeah, we are. And we want to make sure that we are positioned, or your portfolios are positioned appropriately for what might come up. And you can see here that if the Democrats win, we feel like the potential winners are going to be alternative energy, cannabis, electric vehicles. Regardless of who wins, we think small, mid-cap growth, cybersecurity, infrastructure will be potential or likely winners. And if the Republicans win, well, certainly we know energy is likely to do well. Defense, that makes sense. Banks, and then you guys can read the others where we think there's some clear losers or likely losers in the event that the Democrats win, and likely winners in the event that the Republicans win.
That's right. And there are some things that we anticipate really regardless of who would win. We do expect further stimulus to aid the recovery from COVID. I don't think that's really a partisan issue. I think we're all aware that, stimulus may be needed to get us out of this slump. So that we expect really either way. And we also expect actually higher infrastructure spending, regardless of who would win. So there are some issues that, we anticipate that wouldn't necessarily be impacted by who, became the president.
Hey, Ben, it looks like we've got some questions before we wrap up. Julie says, it appears that the Senate has more power than the House. Speak to this, please. Well, in a way, it has more power because there are fewer members. And so fewer people will be deciding policy within the Senate. Other than that, I'm not sure I have additional commentary. Ben, do you have any thoughts around that one?
No, it appears as though, it's going to be a lot. It's going to require the folks that are making those decisions to really make some tough calls, and so I think it will be very interesting to see how that all shakes out.
And there are also some asset classes that we think will be favored versus others, depending upon who wins.
Yeah, so one that was interesting that I hadn't necessarily considered too much prior was actually the impact on municipal bonds and municipalities. A lot of folks are struggling to find yield right now and finding it from good, safe sources. And so we do anticipate with more infrastructure spending, actually that improving the outlook for municipal bonds. There is some rhetoric that if a Democrat were to become president and taxes would be increased, that would also further benefit that municipal bond space. So that was interesting and seems to make sense to me.
You bet. So folks, as we are close to wrapping up our prepared material, I want to make sure that you recognize down at the bottom, there's a Q&A button or a chat button. Either one of those buttons you can click on and identify a question. We have a question from Pam that says, so what has happened when there is an annualized decline? Well, Pam, I think really what the case there is that George Bush started his, I suspect you're referring to that one slide. Go back to that one if you don't mind, Ben, one of the four presidents. That the Bush era elicited a 2.9% annualized negative return over a 7-year period of time. Well, the early stage of his administration, the market did fine, if I recall correctly, and the latter stage, it got clobbered. And it got clobbered because at the end of 07 and well in 08, we saw major financial institutions going belly up. Shearson, Lehman Brothers being one. We saw the concern that the car companies were going to go out of business, the concern that banks were going to go out of business until TARP, which was the rescue plan that Bush and his team came up with to fund companies and to save them from financial ruin. And you may even remember the term too big to fail. So it was determined that these banks and these automobile companies and some of these large companies are just too big to fail. Whether you agree with that philosophy or not, that is what happened, is that the Bush administration came in and pumped a bunch of money into these companies. Much of that money has actually been returned because it was loaned to the companies, and once they were flush again, they paid their loans back to the government. Are there any other questions as we near the end of our presentation? Anybody else out there that might have a question? You want me to pick on you? I can tell who's out there. I might even be able to call on you and say, all right, well, let's see. Who is out here that might have a question? Joe, maybe you've got a question. Jack, Harriet, anybody have a question before we wrap up? I'll look for any indicators of further questions, Ben. I'll let you finish up the presentation here, and I'll have some final comments.
Okay, great. Well, so really this slide does a great job of summarizing our thoughts, which is that you need to stay invested. There's no benefit to you only being invested when there's a Republican in the office, or only being invested when there's a Democrat in the office. An old adage in this industry is time in the market, not timing the market. And we feel as though this is an excellent example. And as we've said many times throughout this presentation, public policy is really only a small part of what shapes and moves a very complex modern economy. And so playing the political game just really doesn't pay off, especially in terms of your investments.
I think the media wants us to believe that this makes a difference because it's something to write about. Sometimes the media, most of the time, tries to sensationalize a story to get our interest. When this story that you see here, I think it's a sensational story, but there's nothing there that causes us to have incredible joy or despair. We make 10 to 15% out of the market every year, on average every year, regardless of whether it's pre-election, election year, post-election, or midterm. And Ben, if you go back to the very first slide we looked at, it's a reminder to all investors that it's really, really difficult to time and get out and then get back in. We don't know how long recessions last. We don't know when they're going to start. We don't know when they're going to end. And as a result, we just say, that's a game we don't want to play. It's a bad bet to bet stocks are going to go down for an extended period of time, because they rarely do. I say rarely because the time they did was the Great Depression. But other than the Great Depression, stocks have recovered nicely, have always returned to all-time highs. So it's a bad bet to suggest otherwise.
Perfect. Well, I think that summarizes our thoughts perfectly, Peter, and I really appreciate you letting me show my face here to the public and participate. This has been a really good time.
Yeah, I see. I don't know if this is a question from Julie. She says, battleground states may be decided by the independent vote, particularly since so many states are now allowing them to vote in the primary. So I think that's an interesting one. That's more of a statement. And Joe said, "Where'd you get your glasses?" So anyway, all of you know, hopefully, that we are happy to talk to you. Actually, here's another one here. Stocks don't like uncertainty. Will it be uncertain after the election? And this is from Pam also. The uncertainty will be reduced, Pam, and that we'll know who our president is sometime after the election. And then uncertainty will come with, I think the biggest uncertainty we have is when we actually get a handle on COVID. Do we have a vaccine that comes out in the first quarter? Are we able to distribute it to 7 billion people in time, in a reasonable period of time? That would be uncertain. We don't know that yet, and the market's really not looking at that yet. The market has suggested that it's confident that a vaccine is on the horizon, and we will be dealing with a way to tackle this virus sooner than later. So Ben, any final comments?
No, like I say, I think that sums things up well. We really don't want politics to get in the way of our investing strategies. The data suggests that it just simply doesn't benefit investors. So yeah, we're staying in it and buying on dips and benefiting from that.
Yeah, actually, that's a really good point. Whenever times are uncertain, and they are always uncertain, guys. It's just, we need to be reminded that all those periods that we look back on in that big chart, that long-term chart, almost every time throughout that, it's been uncertain. And I'll tell you why I know. For the last 36 years, I've had the same question. Since it's so uncertain, Peter, shouldn't we do something different? And I'll say the circumstances are uncertain, and I don't believe the results will be anything different from what they've been, and that is positive performance, long haul with capital you don't need tomorrow. If you need the money tomorrow, you better have some money in cash and short-term bonds. If you can afford to leave that money in the market for, let's call it 3 years or longer, you more than likely will be rewarded for that patience. Anyway, thank you guys so much. I think this might have been our 15th webinar. We're planning more, although we don't have any more on the calendar just yet, but you will see those come up in future emails and invitations. Have a nice afternoon. Thank you.
Thanks for your time.